Listen up, because this is important. We're about to delve into something that affects every single one of us. The stock market doesn't exist in a vacuum. It's deeply intertwined with the world around it. It's like a living, breathing thing, constantly reacting to the world around it. Every event, every piece of information, has the potential to cause ripples. And what shapes that world? News. Pure and simple. From global events to local happenings, it all plays a part. Every headline, every tweet, every rumor, it all has the potential to move the market. The speed at which information travels today makes this even more impactful. Think of it like this: information is power. The more you know, the better equipped you are to make informed decisions. When investors get new information, they use it to make decisions about buying or selling stocks. This constant flow of information keeps the market dynamic. Good news usually pushes prices up, while bad news can send them tumbling down. It's a delicate balance. It's all about supply and demand, folks. The market is a complex web of interactions. But here's the kicker: not all news is created equal. Some news stories have a much bigger impact than others. Some news has a bigger impact than others, and understanding the difference can be the key to making smart investment decisions. Knowing which sources to trust is crucial. So buckle up, because we're about to dive into the nitty-gritty of how different types of news can make or break your portfolio. Stay tuned and let's get started. First up, let's talk about economic data. This is the foundation of understanding how our economy is performing. These are the big picture numbers that tell us how the economy is doing overall. They provide a snapshot of economic health. We're talking about things like employment figures, inflation rates, and other key indicators, and those crucial interest rate decisions made by the big dogs at the Federal Reserve. These decisions can influence borrowing costs and spending. Why should you care? Because these numbers are like a report card for the entire economy. They reflect the overall economic performance. Strong employment numbers usually mean businesses are confident in hiring, which is good for stocks and overall economic growth. High inflation? That can eat into profits and make the Fed raise interest rates, which can put a damper on the market and consumer spending. Keep your eyes peeled for these economic announcements. They happen regularly, and they can cause some serious waves in the market, affecting investments. Trust me, you don't want to be caught off guard when these numbers drop. Staying informed can help you make better financial decisions. Now let's zoom in a bit more and talk about individual companies in detail. Every quarter, publicly traded companies release their earnings reports, and let me tell you, these are big deals. These reports tell us how much money a company made or lost, and offer a glimpse into its future prospects. Positive earnings surprises, when a company does better than expected, can send its stocks soaring. Disappointing results? Well, let's just say those can lead to a serious case of the Mondays for investors. But it's not just about the numbers themselves. Pay close attention to what the CEO says during the earnings call. Are they optimistic about the future? Do they see challenges ahead for the company? Their words can be just as important as the raw data. Finally, we can't forget about the big wide world out there. The interconnectedness of our global society means that events happening thousands of miles away can have immediate and profound impacts on our local markets. Global events, from political turmoil to natural disasters, can send shockwaves through the market. These events often create a ripple effect, influencing investor sentiment and market stability. Wars, trade disputes, elections, they all have the power to move the needle. The uncertainty they bring can lead to volatility, as markets react to the potential for change. Remember what I said about information being power? Staying informed about global events is crucial for making sound investment decisions. Uncertainty breeds fear in the market. When news breaks that could impact the economy, investors often react swiftly, sometimes irrationally. When investors are unsure about the future, they tend to sell first and ask questions later. This knee-jerk reaction can lead to significant market drops. That's why you often see stocks drop sharply in response to unexpected global events. The immediate reaction is often one of caution and risk aversion. The bottom line is this: the stock market is a complex beast, constantly reacting to a never-ending stream of news and information. Each piece of news can shift market dynamics in unpredictable ways. Understanding how different types of news can impact the market is essential for anyone looking to build a successful investment portfolio. Being aware and prepared can make all the difference.